This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
This chapter is looking at a very specific area of capital gains tax. It's looking at shares and how we deal with shares for gains tax purposes for individuals. Now remember, in all our capital gains tax situations, we are looking for proceeds minus cost equals gain. Now when you sell your shares, you will know what the proceeds is because that will be given to you in the question, or you'll have to work it out. So say the shares were worth £4 each and you sold 1,000 of them, you'd be able to work that out. But it's the cost that's the issue. So we're going to look at some very specific rules that you need to learn and some examples which will help you to deal with that situation. So gilt-edged securities and corporate bonds, or what's known as QCBs, they are specifically exempt right from the very beginning of the capital gains tax chapter. And again, you should have watched that before you watch this one and deal with this one, because obviously all the capital gains tax chapters have been dealt with in a specific order to help you to learn progressively. Now, because we don't know the cost of the shares, because we buy the shares, say, over a period of time. So you might buy some this year at £1 a share. You might buy some this next year at £2 a share. Share values change all the time. And because of that, it's difficult to work out sometimes the cost of the shares. So we have what's known as matching rules. And it says there, where shares are disposed of, a problem arises in computing the allowable costs in any company, and it may require there have been several acquisitions over several costs over several dates. So these are revenue rules. So when you sell some shares, they have to be matched against when you bought them. And these are the rules. You have a matching against the shares you were bought on the same day as the day of sale. Shares acquired within 30 days following the sale of those shares, or shares from the share pool. And we're going to deal with each one of those. Now, shares for individuals, the matching rules are different than they are for limited companies, so make sure you're aware of those. They are the same day, the previous 9 days, and the pool. So those are the ones for a company. And when we deal with corporation tax, when you look at those recordings, you will see the information there, and you will be reminded of the company matching rules as opposed to these individual ones. Now, a share pool, first two are quite obvious. Share pool keeps a record of all the different shares that have been bought. It shows the number of shares you bought, the cost of the shares, any bonus or rights issues that may have been given to you during that period. So what are bonus and rights issues? Bonus issues are where a company issues free shares on a proportional basis to existing shareholders. So the value of the shares remains the same. You've just got more of them, so it dilutes that value. A rights issue, where the company seeks to raise new share capital and offers existing shareholders the right to buy more shares on a proportionate basis. So it might be 3 for every 1 that you own, or 4 for every 2 that you own, that sort of thing. It will be clearly shown in the exam, and we've got some examples to show how that works. Now, when you buy a rights issue, it's always at below market value. It's advantageous because they want shareholders, current shareholders, to have more shares. Not only does it have the number of shares, but the cost of those shares, any bonus or rights issues, but any shares that are sold. And we deal with that on an average cost basis. So we add them in, take them out at an average cost. They are time consuming to construct, but if you have to do one, the marker will expect you to construct one, and I'm going to show you how that works now. So Jane owns shares in ABC Limited, so that's the company. She bought 1,500 shares in May 18, and that's what she paid for them. Now, she then bought 500 shares in June 19, and that's what she paid for them. And then in July 2023, she bought another 200 shares, which cost her 4,000. And then she went and sold some on the 28th of June for 25,000. She doesn't work there, so we've got to work out her gains on the disposal. Okay, so let's get a clean sheet of paper and I will show you how that works. So when you have to do one of these, I want you to start with the matching rules. This is going to give the marker confidence that you know what you're doing. So the matching rules are same day, next 30 days, share pool. Those are the rules, and now what we're going to do is match these, and we have 1,000 shares that we have sold. Okay, so let's go back to our question. So she bought some in May 18, some in June 19, and some on the 7th of July 2023. Now, she sold some shares on the 28th of June. Dates are very important here. So we're going to match those first. So she didn't buy any on the same day. However, in the next 30 days, she did buy 200 shares. So we're going to match the cost of those shares that she bought in July with the shares that we sold. And then 800 of them will come out of the share pool. So we're going to have to do two computations because there are two sections of shares that need to be matched. So the first one is the 7th of the 7th, 23. So the disposal proceeds less cost. Proceeds less cost equals gain. Okay. The other one then is the share pool. And we will have proceeds less cost, which will be a working. We're going to construct a pool, will give us a gain, and then what we will do then is add those two together. Okay. Now the proceeds will have to be proportioned between these two computations based on how many shares. So this will be 200 out of the 1,000, and this will be the balance. Oops, out of the 1,000. So the proceeds that we received of 25,000, 5,000 will go in there, and 20,000 will go in there. So we've got that information from the question. Now the question also said that these shares that we bought here, we are matching those shares. That's the cost that we need to put into our computation. So that cost there has also come from the question. So up to this point, you've used the question to answer, to give yourself an answer. Now, what we have to do, this working, let's have a look at working number 1, which is our share pool. So the number of shares, the cost of the shares, the date. Okay, so because the July shares, normally when you do this, you start at the beginning, because we've actually dealt with that one. I would normally go back to the beginning of the question and do it chronologically. So we're going to start with 31st of May 2018, when we bought 1,500 shares and the cost was £20,000. Then on the 30th of June 2019, we bought some more, 500 shares, and they cost us £10,000. So we now own 2,000 shares, and the total value of those shares is £30,000. We are now going to dispose of 800 shares, because that's the figure that we have left to deal with. So all we've done so far is copy the question into the answer. Okay, now we need to proportion this. So 800 divided by 2,000 multiplied by 30,000 will give us 12,000. You may have your own way of dealing with that. That's how I would do it. Okay, so 800 divided by 2,000 times 30,000 will give us 12,000. Now that figure then goes in here, giving us a gain of 8. So her total gain is those two added together, which is £9,000. Okay, so just a quick question or two about bonus and rights issues. As I said before, a bonus is an issue of free shares to an existing shareholder. Now, this is not an operative event, because no cash has changed hands. So what's happened here? Graham has the following transactions. In February 2019, he bought 7,000 shares. In June 19, he bought another 1,000 shares, and then there was a bonus issue later that month, in July, beginning of the next month, a bonus issue, 1 for every 5 that he owns. And then in October 2023, he sold 5,000 shares. So first thing you need to do is match. So there is nothing on the same day, and obviously you would write this out. There's nothing on 30 days. Okay, so we're looking at a pool, which is these three all added in together, and then we will take the cost out. So let's have a look at the model answer to see how that works. So here's the answer to that. We've done the matching rules. Always show the matching rules, even if they are not applicable, because they're not applicable here, because everything's coming out of the pool. But you must show those, because those are the rules, and it shows that you have applied those rules even though they are not applicable. So it is important. Then we construct a pool. Okay, those two came from the question. Now that came from the question too. Bonus issue 1 for 5. So 8,000 shares we owed. 1 for 5 means we get an extra £1,600. 1,600 shares. No cost. Again, dealing with that, you've read the question carefully, that you've done the maths, and you know there is no cost. That will get you an extra mark. So the value of the shares has now been diluted, because instead of 8,000 shares, we've now got 9,600 shares. We are going to dispose of 5,000 shares out of that pool, and again that would be 5,000 divided by 9,600 times £1,900, which is the value. And then we have our capital gains of 20,000 as the proceeds less the cost equals the gain. So let's have a look at what happens if we have a rights issue where some money does change hands. So with a rights issue, we have existing shareholders and they have the right to buy new shares in proportion to their existing shareholding at below market value. So that's a reiteration of the rule. And again, the share pool is increased by the number of the shares and the cost. And again, you're going to have to work that out from the rights issue. So let's have a look at Mark. Mark is an employee at Bromley and he has the following acquisition of shares. He bought some in 2019 for £15,000 and again in June 19 he bought some more. And then in July 19, he took up the rights issue. The wording is slightly different and he paid £3 for every one. And then in September, he sold some shares. Matching rules. Anything on the same day as September? No. Anything in the next 30 days? No. So we're only going to have to do one computation with the proceeds less the cost will give us the gain, and that cost will be obtained by dealing with the share pool. So let's have a look at how that works in the model answer. Again, clearly show the matching rules, write them out, get those marks, because there could be probably one mark for that. Again, you're going to copy from the question, put in the number and the cost. You'll probably get half a mark for that, half a mark for that. And then you will do the bonus issue and you'll get half a mark for copying that out correctly, because you've shown that you've read the question and you understand the situation. So if we had 6,900 shares and we're getting one for every 3 that we own, we're getting an additional 2,300 shares, and they have to be multiplied by £3, which then gives us that. So you're probably going to get another 1 for working those figures out. You'll then get probably another 1 mark for dealing with that, which is 6,000 shares which we've sold out of a pool of 9,200 multiplied by 24,600, which gives us 16,043. Proceeds less cost equals gain.